Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Friday, February 10th, 2023. Markets are now closed for the week. I'm going to do a quick update and point out some levels and developments to watch for next week, as well as some of the things that happened this week. All right, so most recently I've been going through the sectors, the 11 sectors of the S&P 500, and focusing and pointing out some potential levels and potential developments to watch, or I should say actual key levels and then potential developments to watch. In other words, a key level is like a support or resistance level, a moving average or a trend line. I was going to color the rest of these up purple. There's just so much. I'm going to start out here with the major stock indexes, maybe look at a couple sectors, share my thoughts. Bottom line is, yes, we've had the sell signals. The market did rally. We did move off the lows today, so they did buy it up after the initial dip this morning, but not very hard. They closed the S&P 500. Let me make sure I turn off my post-market trades. There it is. So we closed up a quarter point in the broad market, but here's what we have here. And what I'm going to show you is just a bunch of a mixed bag of technicals, both bullish and bearish. I often say, at just about any point in time, I can make a bearish case or a bullish case, and my job's not to, sit there and give wishy-washy analysis. But when there's key levels to watch, and you can make a pretty really what you want to do is be able to make a pretty solid bullish case if you're going long, and a pretty solid bearish case without a lot of refuting evidence to the contrary, if you want to short. Right now, I do think we're probably going to head lower next week, and we could head substantially lower, but there's some work to be done in the markets. Let me just highlight those levels. So this is my clean board, I call it, on the SPY daily chart. So you have the primary bear market downtrend line. I cannot overemphasize the importance of that level technically. It defines the entire bear market from the highs with a lot of clean reactions on there. And recently we took it out. So, if you want to play glass half full, the bulls are in control as long as, until and unless this whole breakout fails, meaning we fall back below the trend line. And you can see it's not just that. There is a confluence of massive or very significant support below. I don't want to define it as massive. That would mean that it's unlikely to be taken out. But this is what has to happen in order to open the door for the next leg down, or at least a swing tradable trend. You've got to, one thing we did is we failed. This was pretty good support right here. It's right about 410.60. You had a reaction low there, another one there, you bounced, then you broke it, came up, consolidated on it for about a week, tried to take it out, failed, hard rejection. Here, ran up, consolidated, tested it, broke out, but that proved to be a false breakout. And the million-dollar question, we'll know sooner than later next week, hopefully, will this prove to be another false breakout there above that level? Since there you took it out, rallied back to back test it from below, hard rejection, right? Did it again, hard rejection. And so we took it out here, but now we failed it. So I'm going to give you the check marks, bull and bear column. I like to do that at times. I like to say, all right, so over here we have, I can't draw it out, a bear or a bull, and I can't do a B because they both start with the letter B, but I'll just say bull case here, and let's say bear case there. So the bull case, well, we broke up, but we failed it. So the bears get a check mark there because the breakout, I always say fewer things in trading and investing are more bearish than a failed long side bullish breakout. You can't write it off completely because we're not so far below it, but we are below it, so I'm going to give that check mark. Then we also took out, well, my drawing tools go away, but you're following what I'm doing here. Then you had the minor uptrend line that was taken out impulsively yesterday, bearish check mark. And this is the primary trend line off the lows, the all-time lows. This is where a lot of bulls, perma bulls have declared the end of the bear market, start of a new bull market. And only time will tell if they're right or if they're wrong, just like they were here and here and here. That's what, long side only traders and perma bulls tend to do is, call bottoms and bottoms and bottoms and in a bear market until they've about given up. All right, so let's not overcomplicate it here. Major trend line support, 200-day moving averages both come in perfectly together. That's this blue line, the simple, the red, the exponential. They pinched, and they come in right exactly where the uptrend line comes in. So If this happens, you take out all of those, you're going to take out in one fell swoop multiple support levels. And is I think the most likely scenario. And I think if it's going to happen, it'll probably happen fast, because that's the nature of a bear market. You've got to be quick. This is a bearish PPO crossover. Let's see if we got it officially. I think, yeah, well, not by much, but here's the close today, 0.01. So we'll call it for what it is, a bearish PPO crossover. Let me park that, put that back, just get it out of the way. And again, this has been, you had the last one was right about here. Then before that, it was right here. And before that it was here, and there was one right there, but these were the above the zero line. These were the big ones, and you can see what happened. You draw that line up from where the crossover occurred, and you can see what happened afterwards. This time, had a little jog down, one last move to shake out the shorts that shorted it. And that's what I was talking about. Maybe we get that next week. I could still see the possibility of that. Give us a divergent high and then get the crossover or the drop. The crossover stuck right there. It held. We made that one last thrust up, another run, another failed attempt at the 200-day moving averages, and a perfect rejection off the downtrend line. And so look, this is the entire bear market. Oh, sorry, I lied. This is the entire bear market, and also you had the bearish PPO crossover right there, right at the highs. All right, so we've only had one, well, starting with the beginning of the bear market, 2, 3, 4 high level, well above the zero line bearish crossovers since the bear market officially started, and this is one of them. Okay, and of those, we were only overbought one. This is only the second time since the bear market started that we had hit the 70 level all the way on the RSI. We came close there. So there's some pretty good evidence, all right, to be short. And I took those swing shorts home. And I won't go heavy until next week. The way it works for me is there's still the possibility that this proves to be a whipsaw or we backtest here. But once we take this out, that's going to be pretty darn bearish. It's going to be hard to argue the case for going long if the 200s get taken out, especially with conviction. In other words, the farther you move away from these levels, the higher the probability goes up that this is the beginning of the next leg down in a bear market with a lot more downside to come. So that's the way it works. There's still, check boxes to be had along the way, take out the previous lows, and et cetera, et cetera, et cetera. All right, that's a lot on that's the broad market. That's why I spent a lot of time there. QQQ, quick look at that. QQQ. Again, this is the clean, simple board. You have the primary trend line, the downtrend line, and the uppermost is really the benefit of the doubt, T-like trend line 2. You had the most likely bounce target zone. We hit the middle of it there in pre-market the first time, also rejected off the 200. Hit the top of it here, and now today we clearly took out the uptrend line, and the bulls had a chance to ramp it back above, but they didn't. So that influenced how I went home and stacked on, added a little more shorts. Again, I won't go heavy until next week, but I plan to increase unless I start to see some move back above these levels. Support once broken becomes resistance. So at this point in time, which you want to watch for next week, not just QQQ, all of them. Look for these trend lines, these bearish PPO crossovers. Again, this one's really close. Will probably come next week. You can anticipate it. You can see these trends. When you're swing and trend trading, this is why it's so much more profitable than investing. These green hills, these are the trends. This is the PPO. It's a trend indicator. That's what it is, and it shows you this is a bearish trend. You want to be short. It's a bullish trend. You want to be long. And here is a bullish trend. It would grind it up. It wasn't a very powerful one. There was a whipsaw in between. But even if you took it on, face value, and that's it. You want to be bearish, short, and out of the market, or short the market when you have a bearish trend, and then long during the bullish trend. Short, long, right? And boom. So this next week, if we go down anymore, you're going to get the bearish crossover on the Qs. Otherwise, sometimes the lines look like they're about to cross, and they head down, and then they bounce, or they give you a little whipsaw. But like I said, it's not a single. I wish I could tell you there's a single level. All I can tell you, there's good price support right there at about 296.50. You have the trend lines below and the 200-day moving averages. So take all that out, then that's going to be pretty darn bearish. And it's the fact that we are still in by just about every metric. Turn off all your lines. Tune out the folks on TV. Everyone's got their own opinion. This is simply a bear market with very little, if any, evidence. Some people might say because we took out the 200s, you're not in a bear market. No. The most simple definition of any trend is higher, or a downtrend is lower lows and lower highs, 1, 2, 3, 4, and the lower lows. So now from here, ideally, you want to stay below this key major reaction high, and then you want to also take out the recent lows. And if that happens, that we're probably going to be in that point of the bear market, which we have not seen yet. That kind of point of recognition, that real, especially with a lot of bulls licking their chops lately and calling for a new bull market with that recent low. I'm not guaranteeing it's going to happen, but I think that's the most likely scenario. And then if it does, that's where we could fall very fast, as there's a shift back out of risk on assets, out of the big tech stocks and everything else. And we're already seeing the evidence too. I don't want this video to be super long, but a lot of those Dow components that I pointed out is not having gotten the memo in the bear market, up to about a few weeks ago. Those were the ones I started adding on individual shorts. Those are starting to roll over. We'll look at that real quick. Let me just go to the small caps first. So there's the levels, and again, solid sell signal with a break below support, and we didn't even come back to back test it. So that is gives us a likelihood of more downside and pretty significant trend lines. And again, a lot of support below. Maybe we catch support. Maybe we do that grind around thing I talked about. We already did grind around for a little over a week there. Or maybe we head down. And again, these are the levels to watch. And they're going to increase the odds, if all those levels are taken out, that we're going to have that a more powerful down move versus just more consolidation around that level. Next up, IWM. I want to cover the small caps. Purple lines are the key levels right here. Big level right there, about 189.50. Why is that a big level? Well, it was support. Broke it right there. Once that support level went, had a hard down, came back to back test it, hard rejection, came back up, consolidated for a couple days, popped it, and came to back test it, but couldn't hold it. So this whole thing right here proved to be a false breakout, aka bull trap. And once you went under it, they tried to run it back again, hard rejection again. Took us to new lows, bear market lows, came back up, hard rejection again after several attempts. And recently tried to get through there again and did pop it. So the $1 million question is, this breakout going to have the same fate as this one, which failed, or is this the real deal? I'll give you my thoughts. Probably fail, but I wouldn't be surprised to see these little whipsaws here. We could pop next week. Like I said, my best case scenario is still, if we do continue to grind around a little more, maybe make an equal or slightly higher high, marginal new highs, and then put in some negative divergence. And if we do that, you're going to blow out a lot of short interest and clear the way for a bigger move down. But we don't have to do that. Bear markets, once the turn is in, quite often it's very fast. It doesn't give the bulls a lot of time to think about it and get out. It likes to trap. It likes to suck in with that FOMO trade, fear of missing out, sucks in, blows out the shorts, and those that were still short from down here, that is, not those that went long here and then reshorted here. And it sucks in a lot of longs, and then that's where you get those moves. So let's watch these levels, all these purple lines, pretty much where we close. We close right on that price support, about 189.50, but you did take out, so that I'm not going to call that bullish just because you closed on a support. It's bullish if you rally off it like that. Bearish if you take it out. So it's really right now a non-event, just a level to watch. You also have, see this purple downtrend line right here? We closed right on that as well. So you have a confluence of key support. And then just below it, if you can make them out, I'll brighten them up a little bit. You have the 200-day moving averages, both the simple and the exponential moving average just below. As with the big caps, the large caps. There's the exponential, there's the simple down there. And we took out yesterday a solid breakdown of the uptrend line. So that's it. So that was a check mark for the bears. This is really a nothing so far. It's a pullback to support, and it's kind of a to be determined next week. So that's why, like I said, it's not an all-in short moment, especially being a weekend, but there's enough evidence, I think, here, including but not limited to the bearish PPO crossovers, the first overbought move above the 70 level on the RSI, just like with the S&P 500 since the bear market began and since right there. So you have a virtually identical technical setup as you did right here. Actually, as you did right here. There was our clean uptrend line. There was a rejection off downtrend line, and more importantly, the uptrend line break, and then there's what followed. The small caps, if they do start moving lower and give up the 189-ish level, you have a move down here. You have support around 181.24. Then they're quite a bit higher above that their bear market uptrend lines off the mid-October lows. So there's quite a bit that they have to do to get down there and then take that out. And they take that out, and then you have that reaction low, and that's it. Just those two. These are the last two really speed bumps, if you will, or potential support levels for the bulls that have taken out trend line, previous reaction low from late December, early January, and then the all-time or bear market lows right there, I should say, mid-October. And so that's it, guys. We'll see if next week brings this and little whipsaws on the indicators and another overbought condition, or this. I'm leaning that way, and I'll certainly stack on my bets next week if the markets tell me to, or may pause, hold off. Like I said, if we get another thrust up, I'll actually be adding there as well. So it's a matter of, am I going to add on a push up, or do we just start melting down next week and going down through there? All right. So sectors, I won't go through each and every one, but XLK, very close. This is the tech sector, the largest in the S&P 500. This 81.41 level, that was what it took to become overbought in a bull market. In a bull market, you tend to become much more overbought. So that in the bull market was my, you can see here, that was your overbought readings when the rallies ended, and you usually get a correction. But we're not in a bull market anymore. We haven't been in a bull market since the end of 2021. We've been in a bear market. And in a bear market, all it takes are moves up to the 70 level, the traditional, what most people consider overbought, and that's it. So we hit that, we're overbought. Then we went on to break trend line support, triggering a sell signal. Purple line shows we have support here at about 139.24. So there's a common theme. So we broke one support level, but we have one that's as important, I would say, is that trend line right below, and then the key 200-day moving averages, which have capped every advance since the bear market started, or without sometimes a brief pop like right here. You had about a week or so you spent above both 200-day simple and exponential, just like you have now, a week or so. And I mentioned that before. It's fairly common in a bear market to see those key moving averages briefly taken out for a relative short period of time. And on the flip side, every bear market ends with recovery back above the 200 days, and sometimes you'll come in and back test them. So like I said, it's anybody's game. Showing you which way I'm leaning right now, and I'll adjust accordingly. So that's it on XLK. XLV, and again, these are charts I've gone over looking for a potential crossover, but hasn't come yet. And as I've talked about, this one's had 3 false breakouts above this multi-year trading range topping pattern, and every time that it's broken out before, it failed. It had a trend line break, went back into the range, and then right back down to the bottom. That's been the MO. So chances are that will continue to be the MO, but we'll see. As of now, and it's number 2, so you want to watch it. There's the primary downtrend line, or my benefit of the doubt trend line right there. So we're still below that. So let's watch that. And PPO. XLF financials. Somebody inquired about this today, but I've been covering these quite a bit. I've been in the last couple weeks, especially this week, highlighting these purple developments and levels to watch. And this one, what the purple lines down here show you are the negative divergences, big negative divergences on the financials. Also, that blue line should really, I'll change it back to purple because that's a key level to watch. That was, and I know this is a busy chart, but you can see here the shaded box right here. That was big support, and right in there, that's where the purple line is. It was, if you zoom in here, I'll tell you what I'll do is turn this off, and you can see it better this way. Take that line right here. See, this is where the financials started topping. They had a topping pattern there. Check, 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 check. A little whipsaw, recovered it. Check, check, and that breakdown was the one that stuck, and that really made the bear market get underway. Took us down to official bear market territory, and this is the first time we've back tested that level since we took it out for good back here in April. So you're at resistance with negative divergences, and all you need now to help firm up or give you another check mark for the bearish case is a break of the uptrend line, which really forms this bearish rising wedge in the financials. All right. XLY, same thing. This is a big one. 4th largest sector, consumer discretionary, downtrend line. This is mostly Amazon and Tesla, with some Home Depot and Nike in there, but the big weightings are Amazon and Tesla. Downtrend line, oops, I drew it a little off. Right here, there's your primary downtrend line. The 200 days come in right there as well. And what you have here is a little island cluster top, I think, or an island top, a single candlestick separated by gaps on both sides. That's a potential topping stick. So that's certainly a check mark for the bears as long as we remain below that candle. Zoom in real tight. And then you can see we are currently back testing the trend line and the 200 days and price support as well, a confluence of major support. And the reason, again, if I was bullish, I'd be buying this hard right now with stops below. That may pan out, but right now, based on this bearish crossover, the overbought conditions, and the fact we're in a bear market, last time we had similar, almost identical technical conditions, including a high-level bearish PPO crossover and overbought, was right here. And you take it up, and then we had a break of that trend line, and that's all she wrote right there. Broke the trend line, never looked back. Okay, so this one, watching this trend line, and if that happens, then we're probably heading a lot lower, and that's going to take the market down with it because of the big weightings there with Amazon and Tesla and the major indices. Industrials. I've gone over these before. It's same thing. You can revisit. Just click on any one of these ticker symbols like XLI down in the bottom of this post. It'll bring you into the recent videos. I haven't made any updates to this line. There's the downtrend line, negative divergence, i.e. divergent high, and only thing I could do here, I'll do it now, is add a uptrend line, which we are most likely going to break next week. Haven't broken it yet. Like I like to say, support is support until unless broken. But the fact that when you get these negative divergences, I often get ahead of breakdowns on rising wedge patterns and things like that. If they appear to be imminent, I'll start scaling in and then add to if and when you get the other breakdowns. That's it. So we'll see where the markets go next week. Like I said, no reason to go home crazy long or crazy short. UNG, we do have, remember we're waiting for a PPO crossover. Maybe it proves to be a whipsaw, maybe not, but we got it yesterday, and additional upside today, about a 5% up day, 5 1/4. and you have a little bit of a range here, but we're above. Remember, we broke out. First, we broke above the downtrend line. We back tested it, but we really need to take out the high of that candle. I think I have it drawn out here on the 60. No, maybe I did it on the yeah, maybe I did it on the futures. Let me see. I thought I had some lines. Let me find the NG. We're still on the, at least I'm still on the March contracts. Okay, this is a daily chart. Oh, and we also, what I wanted to see as well, we finally have now a crossover on the daily PPO of natural gas futures as well. Remember, UNG is kind of a compilation. It'll roll. They're probably rolling, already starting to roll, because they can't do a hard roll. Like me as a trader, I'm in the March. So, a couple of weeks, I'm going to roll into the next forward contract in a single roll. I'll tell all my contracts, and then, but UNG, since they have so many, they'll have to gradually roll. I believe that's the way it works, and so. But I wanted to say that so far we have finally, see that? Looked like we were going to get it back here, and that was the last time I threw it out as a trade idea, and it never did. We never got that crossover there. So this is just another check mark for the bullish case, and one I've been waiting for on both the natural gas futures, and there's that level I was talking about right here. So about 260 on natural gas futures. You can see all these candles here, support, tested 260, tested. So I think if we can pop that next week, we should run. But like anything, it's one trade. I might have cut part of this chart off. It's one trade. Don't put too much, especially natural gas. Beta, adjust your position size down, meaning you don't put as much into NG or UNG as you would put into SPY, let's say. This is the UNG 60-minute chart. I'll have to resequence these targets. That was from that last trade that didn't materialize. But here's the divergence. You can see we've been building positive divergence. A little minor trend line break there. So we'll follow up on that one next week. But as of now, I still like it. Wheat hit that $7 or $8. I call it $8 target right there today. Price resistance. I wouldn't, and I didn't. I'll tell you what I'm doing and not doing. I can't tell what to do, but I'm not taking profits. I think we'll pop it. I think you're going to start to see money roll out. This market's just full of hot money. That's what a bear market's all about. That's why I love trading them. But you got to be quick. When a couple months ago, we were buying tech stocks. What very few were. And now, a week ago, everyone else wanted to buy the tech stocks, and we were selling them. And now, and so where I'm going is, that money is now coming out of tech stocks. At least the last few days, it most certainly has. We're seeing a lot of stocks drop big. Some of my favorites. I put out Tesla. That was down 5% today. I took out the trend line. Actually, took it out a while ago. Told you, back tested a few days. You can see Amazon's been coming down pretty hard. Alphabet, hard rejection at the 200-day on Amazon. All this stuff I've already covered. Again, it's just worth mentioning. This is what a turn in a bear market usually looks like. It's traps. It's the FOMO trade. A lot of folks were buying Alphabet there. They didn't want to buy it here. They wanted to buy it here after a 20-30%, whatever it was, move. And this is what happens to them in a bear market when you chase a rally. You got to get ahead in front of these rallies. I'd much rather get in early, on the shorts, and get in early on the longs than stay too late. That's the thing about a bear market. If there's one takeaway I can give you, don't stay too late to the party on a bear market rally. You do not want to be the last guy or girl to leave the building, because you will be the bag holder. You can see all the same technicals. Bearish PPO crossover a little ahead of time there. Some of these big fangs, big tech stocks have already started to roll over, and the rest will probably follow suit soon. And then back to that commodity thing. That's what I was getting at is, money will flow. It flows out of tech stocks into whatever's hot at the moment. And I think commodities will resume their bull market after a lengthy bull market correction. Corn ready to pop to soybeans. Those are the grains. And you can look at other ag. This one needs to pop right there. Should pop that. Still above the primary uptrend line. Oh, and I wanted to update bonds, and we'll do the VIX before I get away from the equity markets. There's the VIX. So, got faded today. That yesterday's pop, but the breakout's still intact too, and that's another factor for going home short. The VIX is broken out, could fail, but as of now, it's not a fail. It's nothing more than a breakout, and we were only down, less than 1% today. So now I want to show you the bonds because I did highlight those recently. Is all ready to break out, and that's what we've seen. Not a huge breakout. This is the 10-year Treasury bond yield. There's the downtrend line. As I said the other day, we had positive divergence, just like we had negative divergence here. Stock market loves falling rates. This is when everyone cheers and says the Fed, they won the inflation battle, they got under control, they're going to start cutting rates. Stock market rallies, and then interest rates start going back up again, and then stocks go down. So that's it. You can trade the stock market blindfolded for the last year and probably for the next year or more going forward by simply getting the call right on interest rates. So we will watch bonds closely. Rates go up, it tells you that the market's worried about inflation, or it's just inflationary as a whole, and it's also stifling to economic growth. Higher rates raise the cost of capital, amount you pay on a mortgage or to buy a new car, a boat, or a big corporation financing new operations. All right, so there's a solid breakout on the 30-year as well, right there. TYX 30-year bond breakout. So as long as that sticks, then we're likely headed up, and that's going to put pressure on the stock market. Likewise, bond prices move inversely. So you have TLT is the 30-year bond, and that's a breakdown today. So this is where I'm going. Why I do all this, why I talk for 30 minutes. This is just supporting evidence right now. Again, unless it fails. If it fails, and we could do this next week and the stock market rallies. But as of now, this helps support the case for going home short over the weekend. We but we got that breakdown in bonds. And it's pretty clear too. TLT's solidly printed a solid red candle down below there. And so did MUB. I had a BOD, or benefit of the doubt trend line. I had two uptrend lines, but the BOD is lower of the two. This one I think fits better, and so we really broke down a few days ago, but now we took out the BOD trend line, and it's these negative divergences that says it will probably stick and we'll have more downside, and that just shows that does a couple things. Muni bonds are falling, it means their rates are going up. That raises the cost of capital to municipalities. It's also the way the market telling you that something's wrong there, and when the economy goes down, or it's perceived that it's going to go down, then the quality bonds like this, municipal bonds, and investment grade bonds like LQD, these are your high quality investment grade bonds, they broke down as well. They shouldn't be breaking down if the markets thought we were going to have positive economic growth going forward. That's just day one of a breakdown. So that says this is probably a new downtrend to come, a sizable correction that could easily take us down. You got to put a lot into corporate bonds to make money. Remember, and you short bond, you short this, or anything that pays a dividend. The interest off the bonds comes out in the form of a dividend on an ETF. You've got to pay that while short. So you could do it if you want. You just have to take a big enough position to make it worth your while. But I just use this to really, tell me what's going on in the markets, and we're seeing a little stress now in the credit markets there. Junk bonds moving down as well. I don't have a good uptrend line, but I can tell you they put in a divergent high here, and they've been moving lower. That's JNK and HYG are your two junk bond ETFs, both moving lower, fallen as well. So that's it. I think that's all I wanted to cover. Yeah, let's leave it there and pick it up next week. We'll see where we go. See where we open up on the future Sunday night. If anything big happens Sunday night, then I'll get something out, or something early Monday morning. Otherwise, we'll pick it up after the market opens on Monday. Have a great weekend. This has been Randy Finney from Right Side of the Chart.